Good morning, venture capital. This is Metagame, and today's episode is about how the gravitational pull of big money is shifting toward the smallest players making the biggest waves in niche markets. The middle of the venture capital market is ending, and I mean that literally, not metaphorically, not evolving, not transitioning, ending. While everyone's been obsessing over AI valuations and mega-round headlines, something structural happened that most people missed completely. The comfortable middle ground where growth stage companies used to raise their Series C and D rounds, it contracted 3.6% last quarter. Meanwhile, small deals grew, mega deals surged, and the middle got squeezed out. Here's what's actually happening. Capital isn't flowing anymore, it's bifurcating. Picture a barbell. On one end, you've got the small deals, $10 to $50 million, growing at 2 to 3%. On the other end, billion-dollar-plus mega rounds, surging 5%. And in the middle, that $100 to $250 million range where companies prove unit economics before scaling, 825 deals, down 3.6%. That's not a dip, that's displacement. Let me give you the numbers that should keep you up at night. The $10 to $25 million segment produced 1,157 deals last quarter, up 2.6%. The 25 to 50 million band, 854 deals, up 3.5%. That's over 2,000 transactions at the small end of the barbell. Volume, velocity, multiple shots on goal. Companies like Supabase raising $200 million, Verkada at $200 million, MaintainX at $150. Capital-efficient SaaS models with clear unit economics and credible paths to $100 million ARR without requiring billion-dollar outcomes. Now flip to the other end. 483 deals cleared $1 billion, up 5.2%. And here's the part that should make you uncomfortable. Those 483 deals captured more dollars than those 1,157 deals at the small end. That's not diversification. That's winner-take-most dynamics playing out in real time. XAI at $5.3 billion. Databricks at $4.1 billion. Synopsys at $2 billion. Capital flooding into perceived category winners while the middle market starves. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. February's data makes this even clearer. S&P Global reported 912 funding rounds, down 33%, lowest since January 24. But total dollars? $39.8 billion. Fewer deals, bigger concentration. When you see 900 rounds generating $40 billion, that's not a market. That's a selection process. And if you're deploying $50 to $200 million checks, you're swimming against a current that's getting stronger every quarter. So why is the middle ending? Because the middle is proving scale territory, and markets hate paying growth premiums for proof of scale when exits remain uncertain. A company raising $150 million at $1 billion-plus valuation faces intense scrutiny on growth rates, burn multiples, path to profitability. Metrics that looked attractive at 10x forward revenue in 21 are facing compression at 5 to 7x today. The company that would have raised $200 million at $2 billion 3 years ago, now they're raising $100 million at $800 million, technically shifting into a lower band, creating this missing middle problem where companies that need $100 million plus to reach scale can't find investors willing to deploy at valuations that make the math work. And here's where AI makes everything worse or better, depending on which end of the barbell you're positioned. The $202 billion AI funding boom is amplifying this structural shift. AI infrastructure captured the mega deal top spots. XAI, Databricks, companies building foundational model capabilities. These deals command premium multiples because every enterprise AI deployment needs infrastructure, and infrastructure scales geometrically with compute requirements. But AI also dominates the small deal end. Ambience Healthcare at $140 million for clinical AI, AFAL.ai at $140 million for generative infrastructure, 7AI at $131 million. These companies leverage foundation models as commoditized inputs. They reach 10 to 30 million ARR with teams under 50 people by using Claude and GPT-4 as their engineering team for features that would have required 200 engineers 5 years ago. That's capital efficiency that makes the middle market look bloated by comparison. KPMG's enterprise data explains why this makes strategic sense. 26% of enterprises deployed AI agents last quarter. average budgets hitting $124 million. 67% viewing AI as recession-proof investment. Large enterprises pay premiums for proven platforms that de-risk their 100 million plus AI programs. Mid-market companies adopt smaller vendors at 100K to 5 million contract values. The missing middle in enterprise buying mirrors the missing middle in VC deployment. Nobody wants to pay for proving scale when they can either test cheap or buy proven. Traditional growth stage SaaS faces what I call AI displacement risk. The concern that workflow automation built over 4 years and $50 million can be replicated by an LLM-powered competitor at 1/10 the development cost. A customer analytics platform that took years to build now faces startups delivering 80% of functionality in 12 months with $5 million. That compresses valuations and investor appetite for those 100 to 250 million rounds in augmentable software categories. Meanwhile, AI-native companies at the same revenue scale command premiums.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
So what does this mean if you're actually deploying capital? If you're an early-stage fund, the 2 to 3% growth in small deals means competition is intensifying, not easing. Your edge isn't check size, it's conviction speed. Can you close rounds in 2 weeks while larger funds take 8? Can you add value in the 0 to 10 million ARR phase that justifies your ownership? Because mega seed funds writing $15 million seeds are coming for your deals, and they have balance sheets you can't match. If you're a growth fund, the minus 3.6% contraction is existential. If you raised a $500 million to $1 billion fund optimized for 50 to 150 million checks, your natural market is shrinking. Do you downshift into 25 to 75 million rounds and compete with crossover funds? Do you upshift into 200 million plus and compete with Tiger and Co2? Neither is comfortable. The alternative is radical sector focus in categories where mid-market rounds still make sense. AI infrastructure, defense tech, climate infrastructure with long development cycles. Those deals still happen, but you need 18 to 24-month conviction building cycles, not spray and pray portfolio construction. If you're a platform fund with $1 billion plus under management, you're winning the barbell. But are you sized correctly? 5% growth in mega deals means you need larger funds to maintain deployment pace. If you're deploying 2 to 3 billion annually, you need 4 to 6 companies doing 500 million plus rounds to maintain concentration limits. That's a narrow pipeline. Your competitive risk isn't losing deals, it's valuation compression when 5 mega funds compete for the same opportunities. Your edge is balance sheet permanence, backing companies through 3 or 4 more rounds without flinching. The most challenging position right now, fighting the barbell. Raising a $400 million fund to do 75 to 125 million checks and hoping the mid-market re-expands. February's data, 912 rounds, down 33%, suggests this isn't temporary. Companies are either proving product market fit with smaller rounds or raising mega rounds after demonstrating category leadership. The middle is waiting territory, and markets don't pay premiums for waiting. Here's where smart money is actually going. Secondaries and liquidity infrastructure. EQT just paid $3.2 billion for Collar Capital. When primary mid-market deal-making stalls, secondaries accelerate. LP portfolio rebalancing. GP-led continuation funds. If you can't win primary allocation in mega rounds, buying secondaries at 15 to 25% discounts captures the same upside with lower execution risk. Private credit is becoming deal grease. New Jersey just allocated $350 million to Golub Capital. Sponsor-backed software companies raising 25 to 75 million equity rounds are layering 50 to 150 million credit facilities. Smaller equity checks funding larger growth plans. VCs who understand credit equity stack optimization can win deals by bringing packaged solutions that pure equity funds can't match. And vertical focus beats horizontal scale. The barbell rewards concentration. Rather than enterprise SaaS as a thesis, the winning move is dental practice management SaaS, or construction, or legal. The small deal volume, 2,000 plus deals in the 10 to 50 million range, is large enough to support hyper-specialized funds. Category leadership at small scale is more defensible than 3% share in a $50 billion TAM. Remember what I said at the top? The middle of the venture capital market is ending. Now you understand why capital isn't diversifying, it's polarizing. 1,157 deals at the small end, 483 at the mega end, 825 in the middle and shrinking. That's not market volatility. That's structural reallocation. The question isn't whether the barbell is real. The question is which end you're positioned for. Because the middle isn't evolving, the middle isn't transitioning, the middle is getting squeezed out. And if that's where your strategy lives, you're not just behind the curve, you're on the wrong side of it entirely. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.